A huge earnings afternoon with Apple, Amazon, and Meta. Let's go through the worst summary of what's going on. My quick takes on the business updates. Looking at Meta, formerly known as Facebook, 25% revenue growth, incredible acceleration in this business. To see a $40 billion revenue quarter, growing record results, profit margins more than doubled. This is a business that is executing. Management is delivering. You could see earnings per share more than 200% growth. This is a blowout quarter. Exceptional. Management also announced a new dividend, paying out 50 cents per share on a quarterly basis, so $2 per year. It's not going to be a huge dividend yield based on the current share price, but for Mark Zuckerberg, that should be about $700 million a year to him with this dividend. So he won't be needing to, let's say, sell a lot of shares potentially in the future. Management's guidance is also favorable for the next quarter, saying, hey, we expect around $35 billion in revenue, which suggests continued 20% plus revenue growth. And so just continued super strong results. They're not seeing a slowdown in the economy. They are still expecting to invest heavily in Reality Labs, talking about operating losses to increase meaningfully year over year. These are good problems to have because they are already spending $4 billion plus in losses in Reality Labs just in the most recent quarter. You're looking at a company that is spending tens of billions of dollars on their AR, VR bets. It's amazing to see them generate 41% profit margins, even though they still have this $4.6 billion in Reality Labs losses. This suggests that profit margins for this advertising business is just really exceptional, and that this is an incredible business. Management key highlights, go into AI ticker chat to go through the transcript. It's quick key aspects. AI ticker chat is free for that first month. So it's looking at, what is management talking about here? It's their year of efficiency. That was 2023, talking about how they thought managing their costs in a more structured way was actually better for the business. It helped them become a leaner company, helped them improve their execution. Obviously, going through their financials, very, very strong financials, and that they continue to have focus on really important strategic investments, including AI and Reality Labs and their next generation foundational models, coming out with these, open source AI models. So that'll be really interesting to see. Can they come up with something that's as powerful as ChatGPT 4 in the coming year? That's something Mark Zuckerberg has talked about. Looking at Meta, even with a 15% surge after hours, it still only trades around 22 times the family of app earnings. So I'd argue an investor could say, yeah, you're talking about a company around $1.2 trillion, given how profitable family of apps is, as long as the economy is doing well, this advertising business is doing well, investors can say, hey, this is a very reasonable valuation, even with that run up. I think, looking at a business growing 25%, trading at 22 times, a lot of people would say that's very fair. Not surprising to see AI ticker chat using the AI predict feature, suggesting, based on not even updating for their most recent financials, it was previously looking at over 100% upside. So this, this trajectory sort of aligns with, hey, if they continue to grow, and they continue to post, let's say, profit margin expanding over time, just without even significant multiple expansion, you could have very attractive returns for Meta stock. What about Amazon stock, which also reported? I'd say they were good, but not as amazing. It wasn't a blowout. Like with Meta, you see North America results. This includes, a bunch of, their Prime, their advertising business, their retail business, Whole Foods, everything's in there. So seeing North America sales up around 13%, seeing their profitability emerge significantly better. So showing a much better profit margin, around 5-6% on this versus a loss, a year ago period. So it does show that they're taking profitability very seriously. Looking at international, this has been a problem for them for years in terms of just not getting to scale. That said, they are probably investing in the business to say, hey, look, some of these marketplaces internationally are subscale, so we just need to make the loss. We need to make the investment now, so that way we can grow. This is still growing, at a nice clip, up 17%, adjusted for currency, closer to 13%. They have managed their costs significantly, but still, a money loser. as they're looking to compete against a lot of different international competitors. One bright spot is with AWS. The sales growth was okay. The previously is around 12%, so it is nice to see an acceleration to 13%. But the part that I think investors really liked was to see their profit margins expand significantly, now around a little under 30% profit margin. So you're seeing operating income jump 38% year over year. So the profitability jumping on, a more modest growth in sales. It is important to recognize that their top two competitors, Microsoft Azure and Google, are growing much faster. Microsoft Azure is growing closer to 30%. Google's growing closer to 25%. So they are taking share, but there's probably enough for everybody to do well. AWS is much bigger business, growing at 13%, so much slower. It is important to see that Amazon has inflected in terms of their free cash flow, managing their cash, their cash flow much better than last year, going from significant cash burn to now generating $35 billion in free cash flow on the last 12-month basis. So management is very focused on managing for long-term free cash flow generation. The tricky part here is, what's driving this free cash flow and what are they reinvesting in that's so important? And because you can look at their different revenue lines here that are in net sales, online stores, 8% growth. That's not crazy compelling. Physical stores, 4% growth, certainly not compelling. So really what's driving this free cash flow, I'd argue, is these three categories, which is advertising revenue, exceptionally strong, 26% growth, subscription services, 13%, and third-party seller services. So the fulfillment services for merchants, that's up 19%. So these are probably the key drivers of their free cash flow expanding so significantly, plus the growth with AWS. But I look at this free cash flow investment, and it's great to see the free cash flow expand. But I'm trying to figure out, well, where exactly is this, the new growth trajectory coming from? Looking at these business lines, some of them are, I'd argue underwhelming. You're not seeing, oh, they're investing heavily and that's growing this new business line that's not advertising based, that's, growing 30%. You're not really seeing that here. And so there is this sort of surprise element that Amazon is up so much after hours, up around 7%. It now trades around 46 times free cash flow, excluding international losses. It just doesn't scream at me as super compelling looking at the setup with Amazon. What about Apple? So the third of the major companies to report earnings. First of all, in full disclosure, this is not financial advice. Also, quick plug, recently on our exclusive Discord server, a member relayed to me that Unrivaled Investing, the premium subscription, has the best cost performance ratio. This is a direct quote from a customer relative to alternative investing subscription services available. So if you're looking for compelling investment ideas, consider Unrivaled Investing, which includes a weekly letter and my personal portfolio updates in real time. I also have educational courses available that I designed for the types of folks that what I wanted to know when I first started on Wall Street, and the knowledge I've gained working in a multi-billion-dollar hedge fund, thinking about how to value businesses, how to read financial statements. So those are the courses available, once again, at an affordable price at Unrivaled Investing. Looking at Apple, I'd say, the trend of underwhelming performance continues. You're looking at single-digit revenue growth from 117 billion to 119 billion, so around 2%. That said, greater than 2% profit margin, gross margin expansion. You see, they largely driven by their services business, and their operating income growing even faster. And then this all translates through continued buybacks into 15% plus earnings per share growth. So this is the type of thing that Wall Street loves to see, but that 2% revenue growth, that's just not that compelling. What's driving their results? What's, management talking about on the call? They talk about how their installed base of business is now over 2.2 billion active devices. I mean, this is just an incredibly sticky and powerful business. Over 1 billion paid subscriptions. So this is driving this margin expansion across the services on their platform. Think about the Apple App Store, more than double the number that we had only 4 years ago. So this is part of the reason why their margins are expanding. They're also excited to launch Apple Vision Pro. The truth is, though, relative to the iPhone, this is really just a rounding error. Even if it, sells out, you're talking about maybe a couple % of sales. You're not talking about something that's really driving the business. And the downside is the outlook really isn't that optimistic, where they talk about, there was this favorable aspect last year where, in December, there was this supply constraints, and then it caught up in March, and this was a $5 billion benefit last year. And then they're saying, if we remove this impact from last year's revenue, so remove the $5 billion benefit from last year's March quarter, we expect both our March quarter total company revenue and iPhone revenue to be similar to a year ago. So that suggests a possible decline in the business. At least that's my read of this. This isn't, that doesn't bode well for the company. And once again, it's just surprising. It's surprising to see Apple trade around 30 times when you're talking about, effectively a flat revenue growth business. Now, people look at the financial engineering and say, hey, you can get a lot of EPS growth per year, and that is important, and that is important, but that a 30 times multiple, you're talking about a near 50% premium to the market. The S&P 500 around 20 times. So that's a lot for a lot of financial engineering. So it's not surprising to see it sell off a little bit after hours. I'm just surprised it's trading even where it is. And I think, looking at the market in general, and I call out to my subscribers, just this past week, I bought a company around the same valuation multiple as Apple, around 30 times earnings, but growing between 60 and 70%. And it has a long runway to grow. So I just think that there are just much better bargains available. I mean, heck, I can even find companies, growing, faster than Apple that trade at closer to 10 times earnings. That's one of my top holdings that I call out to my subscribers. So I just think that there are better bargains out there for me personally. I just think Apple's too hard. That said, looking at the earnings from Meta and Amazon, Meta's were truly incredible. Amazon, I'm not quite there on the valuation. I hope this video has been helpful for you. If so, please make a point of hitting that thumbs up, hit that subscribe button. Thanks so much for watching Unrivaled Investing.